Hello and welcome to Morning Call. I'm Lata Venkatesh. With me is Sonia Shenoy. After so much excitement, build-up, anxiety, ultimately it looks like a damn squib in the sense that the US Fed did not hike rates. It was just that after 9 years, this would have been a historic moment. It's not quite that historic. It's gotten postponed either by a month or by 1 quarter. But it is perhaps lurking more surely in the horizon than it did before. For the moment, the Asian markets have reacted actually a little bit positively. Yeah. All of them opened in the red and then have clambered back into the green. Well, not quite all of them, but most of them. The Nikkei continues to belabor. But the rest of the markets are showing a little bit of probably a relief that at least at the moment the hike is not there, and therefore the fear that bond funds will pull out has been postponed to a later date. Perhaps under the circumstances, the Indian markets being relative beneficiaries of a bearish comment on commodities should outperform. But 8,000, very big resistance is what everyone tells us. Hi, Sonia.
Hi Lata, good morning. What an anticlimax, right? There was the longest drum roll ever since the start of the year, and finally nothing comes about. But you know, economists were surprised by the second paragraph of the Fed statement, which said that the global volatility will perhaps put downward pressure on inflation in the near term. So although things are fine with the US economy, there is still a large concern about the global slowdown, including emerging markets like China. So that just goes to show that yes, there's no rate hike this time, but the rate hiking calendar continues to remain intact, with just a deferral perhaps to the December move. So that concern remains on the background. But as you rightly said, you know, for our own markets, there could be a relief rally today because the rate hike has been delayed. And now with the Fed trigger out of the way, the market will focus on its own domestic cues, will come back home to focusing on, you know, improved macros, etc. And even as Dipan was telling us yesterday, there's so much domestic money that continues to flow in our market. Yes. Even on Wednesday, we saw, what, 400 crores of buying by domestic institutions. So that could just in the very near term keep the markets afloat.
Well, two things on taking from cues from what you are saying. The domestic money has largely favored mid-caps. And mid-caps did not see that short covering that we saw in the large caps on Wednesday and even for that matter late Tuesday. So it's quite possible that we are going to see the recovery for the moment more in the mid-caps, and outperformance from the mid-caps could be more likely today. And secondly, your point about that second paragraph on the FOMC statement, that's actually being read all over the world as extremely unusual.
Yes.
Unusual. I also sat up all through 11:30, all the way from 11:30 to 12:30 to listen to what people had to say. It was shocking for them because the FOMC is always domestically focused. Yes. So the inclusion of that global phrase has put everyone a little, unguarded as to that statement. Yeah. And also ill at ease is the fact that is the Fed smelling more slowdown and more problems in China than what the world knows? Do they know something that we don't know? So while at the moment you're seeing commodities do a little better because the dollar has traced back. A rate hike would have meant dollar would have definitely been stronger. With the dollar weakening, commodities are actually doing, there's a little bit of green on the crude price as well. But the fear is that if the Fed is smelling so much of a global slowdown, then actually commodities will sell off, and that could really mean a relative outperformance of India to
But
continue.
That just raises a larger question, right, Lata? Although there could be a relative outperformance of India, if they're fearing that there is a global slowdown underway, then perhaps the upsides for all global markets could be capped.
Absolutely, you put your finger on it. Risk assets cannot do terribly well if there is no growth. Exactly. If there is no growth, bonds have to do well. I mean, that's the logical conclusion. So yes, that's why you saw perhaps the biggest rally in US bonds yesterday, and absolutely no rally in equities. Yes. Clearly, the preference is that if there is no growth, why are we chasing the risk assets? That question is definitely going to put a roof, as you say, to whatever little recovery we may see in markets like ours. But for most other markets, there won't even be that recovery because growth is such a big problem in other economies. We may probably scrape the bottom of the barrel and still do some growth. It'll be much more difficult for globally oriented economies. Okay, actually Anuj Singhal, who actually asked for a holiday today, has been dragged from his holiday, and we have forced him to join us on phone since it's such a crucial day. Well, Anuj, good morning. just tell us what have you made of the situation and how are Indian markets sitting? Are they sitting light, heavy, long, short? What should we expect today?
Good morning, Lata and Sonia. So a couple of points. One is that we'll have to distinguish the market reaction today and the market reaction slightly medium term. And I think I disagree with Sonia slightly because I believe that it would have been better for the market if the rate hike was out of the way. In that case, the market would have well shifted focus back to its domestic macros. Now the problem is that this lingering uncertainty is going to continue. And again, the same problem. We don't know what's wrong with the global market if indeed there's second round of fall. As of now, as we speak today, because next week is expiry, a lot of expiry factors are going to play their part. And in that, the FI data is indicating that maybe the market has a bit of a bottom somewhere around 7,700, 7,800 thereabouts. But today, the market will make a bit of a trend move. If the market sustains, if the Nifty rally sustains above 8,000, first of all, it has to cross 8,000, 7,950 to 8,000. So it does that and it trades above that. In that case, there's a good chance of further short covering, which can effortlessly take Nifty in the expiry week towards the 8,200 mark. That's the first probability. The second probability is if the first rally is sold into, and in that case, there's a genuine case of the market seeking lower levels again in expiry week, because expiry week will then be all about momentum. And I think you hit the nail on the head when you spoke about the mid-cap. The mid-cap market for the last 2 or 3 days is signaling signs of distribution. You've seen, for example, on Wednesday, I was watching the market sparingly, and a lot of high-quality stocks like UPL, Eicher Motors, they were giving you a sense that this market is not yet ready to make a durable bottom, and this market has one more round of correction which is left. Now, because the Fed has not hiked rate and because everyone will start talking about now RBI cutting rates, that may keep the market a bit afloat. But if you ask the bulls, they would have been happy if there would have been a rate hike from the Fed, because that would have meant a bit of a knee-jerk reaction on the way down, but that would have taken the poison out and the market would have been ready to move. For now, you're again back to that uncertain times. You don't know when the rate hike is going to come, because that's again then going to keep the market a bit fearful.
No, that point is taken.
We got that short form yesterday from our experts for this, Anuj. People were talking about a dovish hike and a hawkish pause. A dovish hike would have been positive, as Anuj has been saying, and a hawkish pause is going to be slightly negative, and that's, I guess, how, Anuj, you're also reading it. Sorry.
No, Anuj, also, the point that we were trying to make is that this note that the economists have taken very strangely to is the fact that the Fed mentioned that global volatility will put downward pressure on inflation in the near term, and they have never mentioned any word on global volatility or global slowdown in the recent past.
Yes,
Does that give you an indication that perhaps the upside for this market could also be capped, not just for our own markets, but for global markets as a whole?
Sonia, by global, Fed means China, and this is the first indication of China, of Fed acknowledging that China is now the biggest trigger for the market, and that's why I say that it's more troublesome for the market that now more than ever every morning you're going to see what's happening in China, because that's going to be an important factor, and honestly you don't know what's happening in China right now. So I think that uncertainty is what the market doesn't like, is unknown unknowns, and China is an unknown unknown. You don't know what China is going to throw out tomorrow morning or next week. And that is one thing that the market does not like. And that is one thing that, I believe, and when I spoke to a lot of people, they believe that, this is going to keep the uncertainty alive in October. And the market may well have one more downside towards the middle of October, maybe even towards that 7,500 bottom, to test that once again to see if that bottom is durable or not. Technically, this market is looking a bit weak, even if there are rallies. Looks like those rallies would be sold into, just because the global uncertainty is going to prevail now for some time.
All right, Anuj, thanks for that. Well, let's move on and get some opinion as well. Here's what you'll get to see on the show this morning. Joining in first up to assess the Fed impact, we have Peter Hooper, Managing Director of